Hello everyone, thanks for checking out my video. US stock market fell last Friday, pressured by a surge in oil prices and a sharp fall in consumer sentiment as Wall Street wrapped up a super volatile week. Just so you know, oil prices jumped nearly 6% on Friday as the geopolitical tensions in the Middle East continue to escalate. And then we had the CPI data came in hotter than expectation. Treasury yields continue to be elevated, earnings season is heating up, and Jerome Powell is speaking this week. Basically, a lot of things are happening right now, and therefore there are a lot of things to digest in this video. Please stay tuned throughout the video to find out more. The US stock market rally started last week on a strong note but tumbled at the end of the week after a series of bad news. The S&P 500, which sort of represents the broader market, had a sell-off on Friday as oil prices spiked on fears that the Israel and Hamas conflict could escalate into a regional war in the Middle East. And in case you are not aware, the US crude oil futures jumped 5.9%, which marked the biggest one-day gain in 6 months. That was just bad news number one. The other bad news was the consumer sentiment fell sharply this month amid growing inflation concerns. For information, the Michigan Consumer Sentiment Index is a monthly survey of consumer confidence levels in the US conducted by the University of Michigan with regard to the economy, personal finances, business conditions, and buying conditions. There are 2 reports released each month, a preliminary and a final report, released mid-month and at the end of the month respectively. The October preliminary report showed that the consumer sentiment dropped over 7% from September's final report. This means the consumers don't feel so good about the economy. The next bad news was that the latest CPI data showed inflation rose 0.4% over last month and 3.7% over the previous year on a headline basis. Both were slightly higher than economists' expectations, which shows that inflation remains sticky. The saving grace was that the core CPI was in line with forecasts, so I guess that's the good news amongst the series of negative news. Another good news is that we had a largely positive reports from the major financial institutions on Friday as the earnings season got started last week. Basically, the major banks reported robust earnings amid higher rates. In fact, they seem to be thriving as the country settles into an era of higher for longer interest rates environment. JP Morgan Chase profits surged in the third quarter, while Citigroup and Wells Fargo's also beat earnings expectations. Alright, as we enter mid-October, the earnings season is ramping up. Financial sector-wise, eyes will be on Bank of America, who is the last of the top 4 US banks who have not reported its earnings. Additionally, Goldman Sachs, Morgan Stanley and regional banks will also be in focus this week. Personally, I think that together with last Friday's reports, the results of all these banks and financial institutions will be scrutinized for insights into how well they are prepared for the Fed's higher for longer interest rates in 2024. Next, in terms of the technology giants, Tesla and Netflix will be reporting their earnings this week, both happening on Wednesday, 18 October. For Tesla, analysts have been cutting their forecast throughout the year, with the latest cut came after Tesla reported weak Q3 deliveries. In short, Wall Street currently expects earnings per share to drop, and we could potentially see the lowest EPS in 2 years. But does it mean that Tesla's share price will plunge? It's really difficult to say because bulls may argue that the drop in sales have been priced in, while bears will say that Tesla is losing its growth. Personally, I think the movement of its share price will largely hinge on Elon's conference call, and the things to watch would be its gross margins, information about Cybertruck, and any other potential growth drivers, etc. Another key event to watch for the week will be Jerome Powell's speech. He is scheduled to speak on 19 October at the Economic Club of New York, which is just prior to the Federal Reserve's blackout period. He basically will deliver a prepared speech and then respond to questions from a moderator. Let's see if he will throw the market some curveball. Moving over to the technical analysis segment. As always, starting things off with SPY because it represents the broader market. So last week, SPY broke its short-term uptrend as it got rejected at key resistance area around 436 to 438. This area is formed by the 50% Fibonacci retracement level, the 100 moving average, as well as the critical 50 moving average. If you look at the chart carefully, you will see that it tested this area on 4 days and then finally decided to go down on Friday. Additionally, the volume on Friday is more than Monday to Thursday, which means sellers were stepping in. To add on, SPY has broken below this green dotted uptrend channel, which is bearish. In fact, I actually posted on Momo the various bearish signals that I have spotted on SPY last Thursday before the market opened. And later on, SPY had a sell-off on the very same day and the next day. I hope this correct call could earn a like from you. Anyway, this week, watch for two levels. First, it's the 427 level. Second, which is the more important one, it's 420. I have mentioned about this 420 level being very crucial in many of my videos, and I can't emphasize it any further. Breaking below this means the entire market is entering a bearish period, with the final support at 418, which is the 200 moving average. And if you want, you can combine both together, so it will be 418 to 420. If they don't hold, it's bloodbath in the market. On the other hand, if SPY wants to regain its bullish momentum, then of course it has to break above the triple resistance zone that I mentioned earlier, around 436 to 438. By breaking above it, it will also fill that gap between 437 to 438, making it even more bullish. For a full-blown bullish momentum, it has to get above the critical 61.8 Fibonacci level at 440. That's when we can say the broader market is setting up for a year-end center rally. Moving over to Apple's chart, Apple's winning streak has finally come to an end after 9 straight green candlesticks in a row. Two things to highlight on how this streak was ended. Firstly, the candlestick that was formed last Friday is called a bearish engulfing candlestick. Secondly, Apple got rejected right at the critical 61.8 Fibonacci level, which coincides with the 100 moving average, therefore forming a double resistance. This level is around 181 to 182. In fact, in my last video, I shared that we can expect some sellers to step in around this 180 to 181 area, and it happened. At this point, don't you love technical analysis? I mean, look at how Apple got rejected at this critical zone. Again, if you like my analysis, please give this video a thumbs up. Anyway, the good thing is that last Friday's sell-off saw Apple bounce off an important support level, which is the 50 moving average. Come this week, watch this level again, which currently sits at around 178. If it breaks, the next two support levels to watch would be 176 and 173. Just like what I have previously shared, breaking this wouldn't alarm me, but breaking the recent low of 167.6 will keep me on my toes because that's where the 200 moving average sits, around 168. On the upside, it's quite straightforward. If we break and close above the double resistance area of 181 to 182, we can then say Apple's bullish momentum has resumed. When that happens, there is a decent probability for Apple to charge towards 190. Moving over to Tesla now. Tesla is looking bearish, obviously. I mean, can you see that 3 red candles? They look like 3 black crows to me, though it's not the textbook version of it, where the second and third candles should open moderately above the previous day's close. Anyway, I have shared before that the market makers may not set up things or signals so nicely or precise for you. Okay, at this point, if you have learned something, do give this video a like. Also, I am less than 20 subscribers away from hitting the small milestone of 1000 mark, so do subscribe to my channel if you haven't. And if you really found my content useful, maybe you can consider buying me a cup of coffee via my coffee page. Alright, that was just a short advertisement. Back to the chart. Just to share, I tried selling a covered call last Friday, which is a bearish move, but my order didn't get filled. The reason why I attempted to open the trade was because other than the 3 black crows, Tesla has obviously broken its very short-term uptrend. Not just that, the MACD is about to have a bearish cross. All these are bearish signals to me. Come this week is a big week, it's an earnings week for Tesla, so watch out for 250. I repeat, watch out for 250. This is the level where the current 50 moving average and the 100 moving average converges. If this breaks, then I would say Tesla bearish momentum is continuing, and we could say hello to 240s and maybe even 230s range soon. I mean, by now you should know that if Tesla wants to flush downwards, it can flush pretty quickly. But let's say the market makers like Tesla earnings and forecasts, we can then expect a bounce from the 250 level. However, for Tesla to regain its bullish momentum, we need to clear 2 more levels, and they are 255 and around 262 to 263 area. The latter is more important, especially when it just got rejected recently. By going above these 2 levels or areas, it also means Tesla is above the long-term downtrend line again, which it did so twice, but on both occasions it came back down again. Well, third time's a charm? Let's see. Also, I know there is a purple dotted downtrend line there. Let's leave that to another time. Let's take one step at a time. And sorry if the chart looks a little messy, my apologies. Alright, let's now check out Google's technical analysis. And I need to apologize again if I sound like a broken recorder, because I'm going to repeat the same thing about Google again, and that is this 127 to 139 consolidation zone. As you can see clearly from the chart, we have been floating around this range since July this year. And guess what? We are back at this area again after Google broke its recent short-term bullish trend. Yes, we did have a peekaboo last week by hitting 140 and got bulls quite excited. But if you have followed my past videos, you probably won't be surprised that Google gets rejected at that level. I mean, in my very last video, I shared that if it breaks above the recent high of 139, 140 decisively, then it's bullish. But if it gets rejected, then watch out for 134 and 127. In short, this 139 to 140 area is a pivotal area for now. Anyway, similarly for this week, watch for 134 where the current 50 moving average sits. Below this, I think we can kind of ignore 130, as I am of the view that the area between 127 to 128 is more critical, as it is the bottom of this consolidation area, just like how we were watching the 139 to 140 area at the top. So this 127 to 128 area needs to hold. Otherwise, can you see the gap there? It's between 123 to 126. Expect Google to fill at least part of it if 127 breaks. On the other hand, if Google wants to regain its nice bullish momentum that it had created across that 12 to 13 trading days, it will then have to reclaim 139 to 140 area decisively, note the word, okay, and not the sort of peekaboo that we saw last week. Okay, moving over to the options trading section. So last week I didn't execute any trade. I mean, I tried to sell a Tesla covered call, but it didn't get filled. Therefore, there is no live recording this week. Anyway, the first trade to cover for this week is this covered call on Tesla, which was sold on 6 September. The strike price is $320 with a small premium of $155. As you can see from the chart, when I made that trade, Tesla was at 240s to 250s range. At one point, it shot up to almost 280, came back down, and have been floating around these few Fibonacci levels, between 230s range to 260s range. As of last Friday, Tesla basically went back to where it was when I made that trade on 6 September, which is around 250s range. And by now, you should know that such a sideways movement will benefit option sellers like me. So my contract expired worthless and I got to keep the full premium of $155. Okay, the next few trades that are expiring would be these three. All of them are going to expire on 27 October. And I am not gonna hide anything. At the moment, two are in the green now and one is still red. Specifically for Bank of America, I wanted to highlight that it was down about 142% as shared in my last video, and look at how it has swung 100% within a week. So if Bank of America can beat their earnings just like its peers and bounces up, this trade could potentially turn green this week. Anyway, my point is, if you are new to options trading, please be aware that the swings for option trades can be really wild and huge. So bear that in mind before you start trading options. And oh, by the way, I have done 2 videos on the basics of options trading. Do check them out if you haven't. Okay, personally, I would say together with technical analysis, picking the strike price and selecting the days to expiration are extremely important in options trading. So if you wish to get more details about the strike prices that I have selected for my trades and the number of days to expiration that I usually choose, you can consider purchasing this file that documents my real trades in 2022. Also, I have a free option trading tracking sheet for you. This is the file that I use to track my options trades. Do check them out. Alright, let me share some thoughts of the current market. Basically, the current market rally is struggling a little bit amid a series of negative news. The market needs to hold its existing ground and, if possible, make some progress in the next 2 weeks or so. With the earnings season picking up steam, it would be interesting to see if these earnings are the catalyst to push the stock market towards a year-end rally, or is it going to be a final nail to the coffin on top of all the recent bad news? In case you are still not aware or informed of the macro environment, here is a summary of the war of worry, which includes the ongoing Israel and Hamas war, existing Ukraine and Russia conflict, high treasury yields, high interest rates, high oil prices, and sticky inflation. So can you imagine what will happen if the various top US companies miss their already low earnings expectations? With the dark turn in current events, I don't think it's a surprise that the general consumer sentiment captured by the University of Michigan has dropped quite a fair bit. Consumers are feeling a little pessimistic and jittery about the economy. This is also supported by the fact that the Fear and Greed Index has been floating at the extreme fear and fear zones in the last few weeks. And because of the uncertainty in US economy and the ongoing wars, I think it's normal for investors to park their money with safer investment products, such as the bonds, because the existing yields are quite generous. Well, my take is, short-term wise, bonds are indeed a strong competition for the stock market. But if we are talking about long-term, say 10-20 years, the stock market will likely still outperform the bond market. To add on, if you stabilize in the next few months, I think it will create a pretty good environment for the stock market. But of course, a lot of factors play a part before the yields could stabilize or fall. Okay, bond yields aside, the other thing that I am monitoring is the Israel and Hamas conflict, as it could potentially expand to other parts of the region, which may disrupt the oil flows. Just to share, Israel itself is not a major crude oil producer, but the Middle East is. Countries in the Middle East possess close to half of the world's oil reserves, and they therefore play a vital role in global oil production. Even International Monetary Fund (IMF) and World Bank are warning us about inflation and oil crisis amid the Israel and Hamas war. In fact, I think a few months ago I have mentioned that the inflation will reach a point whereby it will be very sticky. In short, bringing inflation down from the current 4% to Fed's target of 2% is definitely not as easy as bringing it down from last year's 9% to 4%. There will be some sort of saturation point where inflation will stick around for a while, or maybe even re-accelerate, and I think the Fed knows it. And that is why they kept emphasizing on this message of higher for longer. Okay, given all this bad news, am I feeling bearish? Nah, not quite yet. But I would say I am cautious about the stock market, as always. But this is only for the short term. Long term wise, as I have shared, the stock market will likely go up. I care about short term now because I trade a bit of options and also because I want to pick up shares when the market falls. Alright, if you have found my content useful, please help me grow my channel by hitting the like and subscribe buttons, and I will see you in the next video. Thank you.